James Dolman from Capital Networks with me. James, welcome. Good morning.
Good morning. Hi.
We're talking Morses Club. Introduce them to us if you would, who they are, what they do and the market they serve.
Yeah, sure. So Morses Club is a UK lender serving the consumer non-standard credit market, in which it specialises in a market segment which is called the home collected credit market. Just to give a bit of background as to the market overall, the UK secured and unsecured prime and non-prime lending market, as of 2015, had outstanding balances around 462 billion. That's quite a big macro number and doesn't really mean anything. So if we just drill down into the relative segments, the UK home collected credit market is a much smaller market. It's around 800 million to a billion in size. It has around 3 million customers, and around 1.8 million of those are what we would consider core customers or regular customers. The types of loans that are being extended to these customers are very small. They tend to be of anything up to about £1,000 in extensions. Morses Club actually have an average customer balance of just £570. The market itself is served by three very large competitors and by a smaller dispersion of smaller firms. The largest firm is Provident Financial, which, looking at customer numbers, has around 50% of the market. Morses Club, the company we're looking at here particularly, is number two. It's got about 12% of the market. And the third competitor is Non-Standard Finance, which is around 5% of the market. So there's a real concentration at the top of the market.
Certainly. Why do you reckon now's a good time to be looking at Morses Club?
Sure. I mean, there are three real reasons why I would be looking at Morses Club now. One is on their own financial performance. The other is the stability of the market and also changes in the competitor base. So looking at the performance, numbers that Morses Club last reported to February 2017 were very good. Adjusted profit before tax is up by 5%, on revenues up 10%. Adjusted profit before tax did lag revenue, but there were reasons for that, including the embedding of acquisitions and also organic business build. The second reason, looking at the stability of the market, this is an established relationship-driven consumer finance provider. They have a history that actually goes back 130 years. These are small, affordable loans. Customer satisfaction scores are over 90%, so it's a very stable market. Looking at the competitor changes, the largest driver, we think, of the near-term business are changes in which the largest provider, this is Provident, they're changing its business model to exclude some of the areas of traditional home collected credit business. Morses Club see this differently and are looking to pick up business where PFG, Provident Financial Group, are leaving off. So they're looking at areas where PFG are contracting lending and looking to build out their own sort of capacity in those markets that PFG are leaving behind. So we're seeing collections overall for Morses Club consistently being greater than extensions. We see sensible levels of impairment being taken because obviously there are some areas in which customers don't repay, and therefore a sensible level of impairment needs to be factored in. And Morses Club have remained profitable really over the last 10 years. So despite the fact that we've had a global financial crisis and the fact that customers have felt some pressure, they've actually been able to remain profitable.
So quite an exciting time for them. What does the future hold for them? What can we expect in the coming months, say the next 6 to 12 months?
Sure. I mean, some of the themes that I would be looking at is that the regulators are increasingly looking at this marketplace and they're increasingly favouring, in my view, the better placed competitors, the ones that are more able to withstand not only the current regulations but also the current monitoring and embedding of regulations. So if we look at the Financial Conduct Authority, they're looking into high-cost short-term loans. There are interest rate caps that they're considering and admin fees and compliance with the CPA as well. Morses Club meet all of these requirements currently, so I think they're very well placed within the market. The FCA, I suspect, are looking at the tail of firms within the home collected credit market. Those are, some of those are applying for authorisation, but meeting the requirements of not only initial authorisation but also ongoing authorisation, I think will be quite tough for some of those smaller firms. So I suspect the market will consolidate, or assets will come up for purchase. And I suppose the other big area that we should be concentrating on is as technology online and digital content for loans is going up all the time. Morses Club is very well positioned, I think, to look at parallel markets for certain product types and for certain customer groups where there is a sort of cross-sell opportunity. They do have Loans, which is essentially an online home collected credit type provider for those customers that would prefer something online. And also they have the Morses Club card, which enables people to deal in a non-cash form of credit. Those are in their infancy. And I think we can expect good things to come from both of those areas.
So plenty of opportunities and well positioned for future growth. James, thanks for your analysis.
Thank you very much.
James Dolman there, Capital Network, talking through Morses Club.